Stock of the day is IBM. We're going to look at IBM's artificial intelligence powered surge, and if now is the time to sell or hold your IBM shares. Now, IBM has been on a tear recently. Over the last year, its shares have risen from $135 to around $183, a gain of approximately 36%. So is it time to sell IBM and lock in some profits, or should investors hold on for further gains? Let's discuss. Let us know what you think in the comments below as well. It's always nice to hear what people think. Now, IBM is having a lot of success in artificial intelligence right now, and this is helping to push revenues higher. In January, the technology giant advised that orders from its generative AI business, which includes booking and sales from services such as those powered by its Watsonix AI platform, doubled in the fourth quarter of 2023 relative to the third quarter. This strong growth from AI is expected to lead to overall revenue growth of around 4 to 6% in 2024, and that's a higher level of growth than Wall Street analysts were expecting going into the Q4 earnings. The company also expects to generate around $12 billion in free cash flow from 2024. In the Q4 results, IBM Chairman and CEO Krishna said, "In the fourth quarter, we grew revenue in all our segments, driven by continued adoption of our hybrid cloud and AI offerings. Client demand for AI is accelerating." Of course it is. AI is a massive buzz at the moment. Everybody loves it. So clearly, the company has momentum at present thanks to AI. The stock's valuation remains undemanding. However, with Wall Street analysts expecting earnings per share just over $10 for 2024, the forward-looking price-to-earnings ratio is just 18. That multiple is a lot lower than the multiples of some of the other tech stocks like Amazon and Apple. Meanwhile, the company's market cap sits at $168 billion. The forward-looking free cash flow yield is around 7, and that's quite attractive for investors. These valuation multiples and the current dividend yield of around 3.7% suggest that IBM stock is not overvalued right now. Therefore, it could be worth holding on to the shares if you think they've still got legs. It is worth noting, though, that after IBM's recent Q4 results, several brokers raised their 12-month share price target. One broker was Jefferies, which has a hold rating on the stock. It raised its price target to $215, citing the free cash flow story. Another was BMO Capital Markets, which has a market perform rating on IBM. It lifted its price target to $210, and these price targets suggest that analysts believe the stock can rise to a higher level in 2025. But, well, is IBM a safe investment? Well, all stocks have their risks, and IBM is no different. In this case, competition from rivals is a key risk. IBM is up against some formidable players including Microsoft, Amazon, Google, Oracle, Hewlett-Packard Enterprise, and Accenture. All of these companies could potentially steal market share from the company. Another risk is the economic slowdown. This could hit enterprise spending. In IBM's Q4 results, the CFO noted that the company continues to operate in a very volatile and uncertain economic environment. So this is another major issue to monitor. Overall, though, I don't see why the tech stock is that particularly risky. The valuation isn't stretched and the dividend yield at nearly 4%. These give two potential sources of return here. Again, though, this isn't investment advice. As always, it's guidance and pontification. Let us know what you think about IBM in the comments below, and if you want to see our most recent analysis on the stock as well as our ratings, go to Good Money Guide, search IBM.